So, huge video here on the bear thesis, the inverted yield curve, and the Cantillon effect. What does that tell us? This is a big video on economic thought and theory, and if you're an investor, this is an important one to pay attention to. Just as important as it is for you to check out the flash sale on the only programs on building your wealth that I am sponsored by on the channel. In fact, it's the only sponsor on the channel. My own programs on building your wealth as a real estate agent, an entrepreneur, an employee, setting up side hustles, or wanting to get ahead with the psychology of money, stocks, real estate investing, you name it. You had lifetime access to the course member content when I had new content and the live streams on building your wealth and answering your questions. Check all of those out. Link down below and use that flash sale expiring next week. Now we got to talk about the Cantillon effect. It's a French word, it's a French effect, and it's really impressive because it might blow your mind in terms of traditional economics. But what I'm going to do to start with this effect is I'm going to introduce what Jamie Dimon just said, and it'll show you why this effect potentially is so important. So take a listen to Jamie Dimon here for a moment on Jim Cramer. We're not going to listen to all of this, but let's get started.
Wrong, because maybe that's too short a term. Maybe what we're thinking about when we talk about the Fed is not what is happening, boots on the ground here.
Yeah, I think they're different. I mean, the Fed, look, I have all respect for Jay Powell. But you know, the fact is we lost a little bit of control of inflation. Models didn't pick that up. I've always been suspicious of models, and when we use them extensively, I always say that you use a little bit of judgment too. And there's been a sea change. Governments are borrowing a lot of money, and you got to incorporate that in what's taking place. That means they're spending it. That's inflationary. Wages we've seen come down, but not so much.
Right.
Oil and gas will probably be going up because the investment has been curtailed. Right. And the green economy, we think it's close to $4 trillion a year of additional spending. So you're talking, and the IRA Act, which I think has a lot of good stuff in it, the Infrastructure Act, the CHICS Act, this is huge money. And so, you've had a sea change. And I think we should all get adjusted to that. And, we'll have more normalization of interest rates, and we'll be fine. Just remember, America's the most prosperous area on the planet. We'll be fine.
Okay, but
I'm going to pause there because the rest is actually less interesting. But let me just highlight some of the things he mentioned here, and then we'll get into those models. So first of all, Jamie Dimon is really taking this position that, I don't know, man, even though we've gone away from sort of the monetary money printing, which is the Federal Reserve basically bailing everyone out, via essentially the unlimited money printing, which was then distributed via stimulus checks, unemployment pay, PPP loans, whatever. What you actually have now is Jamie Dimon saying, look, the Inflation Reduction Act is cool and all, but energy, green energy, is $4 trillion of potential new inflationary impetus. Government spending, government subsidies could actually be the next wave of stimmy checks. That's actually really interesting. He says that because one of the things that I use to describe the CHIPS Act, which is another act that was just passed, which is massive, $80+ billion of support and subsidies, and then sanctions and restrictions on chips, specifically for chip companies and preventing China from being able to access some of our technology, although they just steal it anyway. Those are basically massive stimulus checks for the chip makers. I mean, Taiwan Semiconductors, Intel, NVIDIA, doesn't matter whether it's the chip maker or the actual chip designer. There is so much stimulus money going into energy, batteries, EV chargers. Look at the stimmy checks basically Tesla's going to be getting from hanging out with Joe Biden. Hey, yeah, we'll open up your supercharger network in exchange for a few billies so we can make more superchargers everywhere so our Tesla owners don't get pissed off at all the congestion that we're going to create by letting other people use the chargers. Jamie Dimon, in the nicest way possible, is basically saying we are going from people stimmy checks to corporate welfare in chips and energy, and it's going to have a massive inflationary impetus. That's actually, by the way, how China stimulates. China during this recession or sort of this COVID pandemic did not stimulate their people with stimmy checks and cash. The people had to go save their own money. It was very difficult for Chinese individuals relative to Americans or even Europeans in regards to how much government support we were receiving on an individual basis. And in China, you focused on corporate welfare, corporate support, corporate stimulus. Well, that's basically what Jamie Dimon is suggesting we're moving into, this potentially new inflationary regime driven by government spending and how we have to ignore models, traditional economic models, and we're likely to see what he says is a normalization of interest rates. That's a way of saying we probably won't be going back to 0%. Maybe we're going to stay at a Fed funds rate of 3 or 4% for quite a while longer, and we've got to get used to this idea. And that means markets really have to adjust to higher rates for longer. That sort of reiterates what I've said earlier. Patience, patience, patience. It's a very interesting idea. But another very interesting idea that somewhat compounds what Jamie Dimon suggests here is the following. And this is so remarkable. I'm gonna read a lot of this and add commentary. It's not that long. It's really worth it because in my opinion, it's just mind-blowing insight into perspective on economics. So if you're an econ person, this is phenomenal. I mean, like I usually think the flash sale on the programs on building your wealth that's going on right now, or the shadowing experience, come learn from me directly, ask me questions, whatever. I think that's incredible. And that's a really good deal. But this effect is insane. All right, you ready for this? So I really like this. Let's go through some of this together. So the Cantillon effect is a change in relative prices resulting from a change in money supply. This is that sounds complicated, but it should be a very, very simple. Basically, what is being said is, look, inflation occurs when you change the money supply, how much money supply there is. We're gonna keep going here in just a moment because it gets more interesting than that. You might think to yourself, oh, well, that's obvious, right? Like you print more money than you get inflation, right? Not necessarily. And this is the crazy thing about what Jamie Dimon says about models, because The Economist just talked about exactly this as well. So The Economist did this really, really good piece. The piece is right here. And it's lots of investors think inflation is under control, not so fast. And if we go through this piece, we'll actually find that there's a lot of talk about sort of the traditional idea of inflation, which is that, okay, well, if we have higher rates, we have higher rates to fight inflation. And basically, the way we calculate inflation is just as a formulaic measure of what's unemployment and what are rates doing. That's sort of the old school and traditional Keynesian way to look at inflation. But The Economist makes this really interesting argument right here that aligns with what Jamie Dimon is saying and aligns with what the Cantillon effect is saying. Take a look at this. Tracking the money supply is deeply unfashionable. So again, when I read that definition of the Cantillon whatever effect, you might be thinking to yourself, oh yeah, well duh, inflation goes up when the money supply goes up, right? But look, it's actually not the traditional school of thought. Even The Economist reiterates that. Tracking the money supply is deeply unfashionable. Since the 80s, central banks have generally focused on interest rates rather than trying to fix the amount of money in circulation. Money does not even feature, as in other words, money is not even a part of the, quote, state-of-the-art models, there's that word models, of inflation. In other words, the models of inflation that we use today don't even care about the money supply, which completely ignores the Cantillon effect. I have no idea how to say that word, so I'm just going to keep going with that, by the way, and I'm not going to excuse myself anymore. So here we go. Which the traditional models are interest rates, the real economy, which includes labor, and inflation expectations. So in other words, traditional economic models say, hey, we got to look at what are rates, what's the economy doing, and what are expectations of inflation. We've heard that a million times before, certainly from my channel as well. Hey, as long as inflation expectations are anchored, maybe we're okay. But that's also important to make sure that we're on the path towards disinflation. Otherwise, oh God, otherwise those expectations will break, and then we have to make things worse. Like throwing your pencil. Oh, I hope I didn't break the tip. Oh, it still works. Okay, cool. Anyway, so what do we have? Yet, the money supply was one of the few indicators to provide an advanced warning of inflation across the OECD, Organization of Economically Developed Countries. A broad measure of the this sort of warning supply or warning from the money supply shows that we saw a 12% increase in the 6 months after February 2020. So in other words, by about August of 2020, which was really about a year and 13, maybe a year and 3 months. Yeah, about a year and 3 months before, like getting to the end of 2021, where we really started getting nervous about inflation, we actually already saw the warnings in the money supply. And it was a massive red flag that big inflation was coming simply by looking at the expansion of the money supply. But it's not just the expansion of the money supply that's interesting. We'll have to go into detail about that. So let's keep going. And I'll tell you, if you think it's just money supply up, higher inflation, that's actually wrong. It does have to do with the money supply, but it's actually the derivative of the money supply that matters. I'll explain that in a moment. I'm not a big fan of calculus either, so don't worry about that. But I'll explain that. So let's keep going. A recent study by economists at the Bank of International or for International Settlements finds that countries with stronger money growth saw markedly higher inflation, and that incorporating money growth into inflation forecasts would have improved their accuracy. So in other words, maybe what we need to do when we're trying to predict inflation is actually look at the change in money supply growth rates, there's the derivative, and then we might know what could actually happen with inflation. We're going to go back to the Cantillon effect in just a moment, but let me explain that. So if the money supply, okay, so let's call it the M2 money supply, is going up like this, do we have inflation or not, according to what we just read from The Economist? Well, the answer actually is no. Now that seems weird, right? But that's because this is linear. Okay, now let me change that. If the money supply is growing like this, do we have inflation or not? The answer is yes, because the derivative, which is the rate of growth, here is exponential. Here, the rate of growth is constant. So the growth rate is, if we're now measuring the first derivative, which is like the acceleration, think about it like when you hit your gas in your car. If you get to one level of acceleration where you're adding maybe, I'll just say a mile per hour per second, let's just say, your actual rate of growth or your acceleration is actually constant, right? The graph of your acceleration is constant. It's flat. You're accelerating at the same speed. When you're accelerating at the same speed, your potential and your money supply is rising, you're not actually creating inflation according to this argument. The argument is actually that when you hit the gas faster and faster and faster, and you're accelerating faster and faster and faster, and your derivative line is growing. In other words, the rate of growth is expanding. So in other words, if you're thinking about like company earnings, think about that a little bit differently. Think if you're growing at 25%, 25%, 25%, your rate of growth is constant, right? But if you're growing at the money supply at 25%, then 35%, then 45%, or maybe even 50% to go along with the sort of the more exponential curve there, maybe it's even 60%, right? Now your rate of growth has shifted from a constant to much faster. What happens when you do that? Boom, inflation. That's where the inflation comes from. And it's really interesting because if you look at the money supply graph, you could see right here, look at the constant, almost constant increase of the money supply here, right? No inflation right here during all of this. No inflation. But look at when the rate of growth changed. Boop, big fat rate of change, right? That was a red flag. That was a huge warning signal that said, uh-oh, the rate of change has exploded. We're about to deal with a whole hell of a lot of inflation. That's fascinating. Now let's keep going with the Cantillon effect. Okay, I feel like I'm saying it like an Italian, but it's actually French. See, it came from a 1680s book, which actually came before Adam Smith and the Wealth of Nations book, and it's the Essai sur la nature de commerce in general, whatever. Essay on the nature of trade in general. Okay, whatever, who cares? So, since the 2000s, the world's largest central banks started to run out of policy tools, like lowering interest rates, and many were aggressively creating new money during each major financial crisis. Yeah, so you have a financial crisis, they just turn the money printers on. The current state of the U.S. economy is experiencing inflation expanding during the Biden administration at rapid levels, resulting in the increase in prices that occur in energy, blue-collar labor, and food, but not in other products and services. Keep in mind, this article is a little bit older, but it teaches us a principle that is very important today, okay? It's very important to internalize this one. I would write this down in your notes somewhere because it's so interesting. But anyway, with the creation of the U.S. Fed and the U.S. exiting the gold standard, the C effect has favored investors and owners over wage earners, workers in the aggregate. Okay, I started my channel around that thesis. My channel exists around the belief that you will not build wealth if you are not either an investor in stocks or bonds, real estate, or businesses. That's it. You have 3 choices to get rich in America, okay? Stocks, bonds, businesses, real estate. If you have none of those, you're probably poor, and you're gonna stay poor. It's just like, I wish they would teach you that in 5th grade so you could like put that mindset to work earlier, but you don't. Most people don't learn that until they're like 25 or 35 or 45, and then it starts getting too late. It's sad, but I don't know. Maybe they do that by design. It's sad. The C effect also had a theory in which the beneficiaries of the state creating the currency is based on the institutional setup of that state. This essentially means he who is close to the king and the wealthy likely benefited from the distributional choices of the currency through the system. Think about all the PPP money, right? Like the people with, guess what? Real estate, stocks, and businesses got the gold. Anyway, since the 1950s, most of the world has adopted a Keynesian style of economic theory. In times of financial crisis, the central banks are used to increase the money supply, and the large banking institutions, like Jamie Dimon and the capital markets, distribute or lend out that money, calm markets, and prevent bank closures. Time and time, it is clear that in the case of the U.S. capital markets, many of the U.S. banks, large private equity houses, and Wall Street fare well after central bank QE. I mean, that's obvious. So they turn on the money printer. Who wins? It's banks, private equity, and Wall Street. Whereas you individual savers are usually the ones who deal with the jump in inflation and the loss of purchasing power. That's during a QE regime, right? So in other words, they're saying, look, under the Keynesian economic school of thought, when you turn on the money printer to sort of minimize the effects of a recession, you're really benefiting rich people more. You're hurting poor people because of the inflation you're creating thanks to the derivative change, or the change in the derivative of the rate of growth of the money supply. Anyway, chanting the phrase by various heads of state of Build Back Better can essentially mean who gets the new money out of the crisis and where shall that capital be allocated. Okay, now this is interesting because look how crazily this relates to what Jamie Dimon says. Jamie Dimon says, energy, like the green explosion, basically chips, right? That's who wins. That's who wins. That's awesome. All right, so by analyzing the current U.S. financial and economic system, tech companies like Amazon, which lobby the U.S. government, and U.S. airlines benefited tremendously. That could be said of other governments across the world as well. The pandemic was a boom for the ultra-rich, according to the World Economic Forum. Interestingly, with the passage of the CARES Act, PPI, UBI, basically, blah, 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 we basically supported businesses. Okay, fine. With the Federal Reserve now preaching about the risks of U.S. income inequality and climate change, which is interesting as their QE policies have clearly widened the income gap, what policies can be used to mitigate the Cantillon effect? How are institutional investors such as sovereign wealth funds, pension funds, and basically how is Wall Street getting ready for the crash, so to speak, when QE goes away? Now, what's interesting is I didn't tell you this, but this was written basically at the top of the market, October 2021. In other words, they used the Cantillon effect to predict the disaster that was about to happen. In other words, hey, QE, really great for Wall Street, private equity and businesses and the rich. But when that QE flip-flops, be careful. It's going to be hard unless you have new forms of government support. Now, what complicates things today is we do have new forms of government support, and they happen to be in energy and the green space, as well as chips. There's a reason why when I keep talking about my PP, that is pricing power stocks, when I keep talking about PP, pricing power style stocks, there's a reason why I think there's a massive wind at the backs of chips, AV makers, battery makers, etc. There's a reason, okay? That's why I'm a big fan of pricing power style stocks. especially based on the handouts of government stimulus. Unfortunately, the Cantillon whatever effect now suggests that we're having a reversal of the massive inflation effects via looking at the M2 money supply. We could see that the previous rate of growth that we've had in the M2 money supply has actually turned negative. Now, that's obviously because we're going through a quantitative tightening cycle. So let me explain that in relation to this effect quickly. If previously, and I'm just gonna overly simplify this, okay? If previously we were growing the money supply at 2% a year, so we're going plus 2%, plus 2%, plus 2%, there we go. How much inflation do we get? 0, because the rate of change is actually constant. So it's almost like inflation is a factor of the rate of change in the expansion of the money supply. So when this all of a sudden became, say, plus 10%, right? During the massive money printing we went through, what did we get? Oh, wow. We got, basically plus 10% inflation. Holy smokes, how simple. It's almost scary how simple it is. But the warning signs were there. And just to show you kind of maybe where we are with actual numbers today, let me go to this piece right here. They show us how close we are. I'm pretty sure when I get to green over here, there we go. Look at this. The expansion of the money supply is about 17% today, and consumer prices are about 14% above trend today. In other words, consumer prices are almost completely caught up to this change in rate of the expansion of the money supply. Okay, so let's go back to where we were under this page. Okay, so 0 rate of change, 0 inflation, money supply is growing constantly. Massive increase in the money supply, M2 here on the left, right? And what happens? Inflation skyrockets. What are we actually getting now? Well, now we're actually in this environment where we're reducing at, let's just say, a constant rate. Okay? So the money supply is declining at a constant rate. So gee, I wonder what's going to happen with inflation. It's obvious. It's gonna go down. This is where people are like, and including the bulls and the bears, are slamming their heads against tables going, Fed, like it's gonna go down. You're going to overdo it. And the recession is going to be what the bad part is, because you're going to destroy so many companies. And this is where you get a lot of the bears saying, look, there's no reason why companies should be becoming more valuable right now, especially in certain sectors, which I believe are ones that don't benefit from the new sort of stimmy checks. That would be staples, grocery stores, staples, McDonald's, restaurants. These guys, in my opinion, Costco's, right, whatever, these are the ones that are probably going to end up getting screwed in the next few years. And it's the ones that are getting the stimmy checks while we're visiting deflation that, in my opinion, are going to see the massive explosion of value. And that's why I personally am so heavily focused right now on chips, EV, battery makers, et cetera, Tesla, whatever, because we're likely to see that disinflation, while at the same time the people getting stimmy are these sectors. So while you get disinflation and the Fed likely pushing the broader market towards recession because they're so behind, they're not paying attention to the Cantillon effect. They're not paying attention to that. Instead, they're paying attention more to the traditional Keynesian economic school of thought. You probably have the Fed pushing us over the edge into a sort of a darker territory, which is bearish for a lot of markets broadly. But in my opinion, actually oddly bullish for the ones who are surviving and getting the stimmy checks. And those are those here. So hopefully you learned something with the Cantillon effect. Man, take a shot every time I've said that in this video. You'll be fine. Just don't drive. Now, fair follow-up here. You say a constant rate of M2 increase didn't lead to inflation. How does a constant rate of decrease mean deflation? Okay, let's clarify that, because you're right. When we go back to the question mark I drew here, the point that really is being made is it's to say that, okay, if we're switching, so when we inflect, there will be an impetus change, And even if that impetus change is going back to zero, right, which is not deflation, this change right here is considered disinflation, right? Going from a higher level to a lower level, that's considered disinflation. Going negative would be deflation, right? Generally, it's going to be technology that's going to push you into deflation, which could happen. But you're right. Let's clarify that. Let's not go as far as calling it deflation. But the idea would be, if we're getting to this impetus of a contracting money supply, we should be approaching zero. Now, obviously, this is a broad effect, and it's hard to sort of micro down and say this is exactly what's going to happen. But I would guess solely by looking at this effect, and of course the leading indicators we're looking at, whether it's corporations, earnings calls, whatever it may be, and the supply of labor, which has exploded. We do still have crazy labor mismatches, though, which is a problem. But anyway, we would expect to see disinflation over the next few years very, very rapidly and very quickly. But when I say very rapidly, that's over the span of a few years. And so I suppose you have to zoom out to call that rapid. But I do think that in 10 years from now, we look back and we're going to go, wow, yeah, money supply was expanding at a constant rate. Okay, no surprise. Inflation was what? Stable. Oh, you all of a sudden expanded money supply super quickly. What happened? Oh, wow, you had inflation. Oh, then you went back to a stable money supply and a stable rate of now contracting money supply. What happened? Oh, wow, inflation basically went back to stable, right? This period of time right here, I think this is what you'll end up labeling as, there we go, let's write this here, transitory. Now, again, that'll be painful because it'll actually have been 2022 to probably 2024 or 5, right? So this period of time will have felt very long and hellish, but it could, according to this principle, should end up proving to be accurate. And then who wins during that time? Well, again, the ones getting the stimmy checks, in my opinion.